Hello, and thanks for joining. My name is Tim LeMasters. I'm a director of our Alliance Network here at McGuire Sponsel. Joining me today is my colleague, David Seibel. David is a principal in R&D practice and has a wealth of knowledge when it comes to Section 41, 174, and all things R&D tax credits. We're really going to kind of touch on a subject today that obviously is top of mind of everybody's. And 174 has been a major issue over the last couple of years. Although it is what it is, we know that there's been some major concerns. So we want to just talk about and highlight some things for those clients that maybe have not been able to utilize 174 as it's been appropriated by the IRS. There's obviously was some language that came out early 2022, and then we got some kind of clarification on what it actually looked like in September of 2022 as well. So Sly, why don't you just do us all a favor and kind of just give us just a quick recap on what we've been experiencing with 174 here over the last couple of years, and then we'll dive into maybe some adjustments that we can make.
Yeah, sure, Tim. Thanks for having me on. The big takeaway to get everybody up to speed on 174 is, as part of the Tax Cuts and Jobs Act, the option to expense 174 expenses, which are research expenses, the option to fully deduct those is no longer applicable for tax years beginning after December 31st, 2021. At the time when the TCJA was passed in 2017, everybody thought that this was going to be a provision that would get repealed down the line. Then as the 2022 tax year concluded, it became apparent that that was not going to be the reality of the situation. So we went through a year of very little guidance, as you mentioned, and trying to comply with the tax law for 174 to make sure taxpayers were in compliance with the law. Went through a similar exercise for tax year 2023 as it neared toward the end of the year. We thought that there was a possibility that it could be repealed. That again, there was a few opportunities to do so, but it just didn't end up happening. So again, we went through another year with a little bit of additional guidance to provide us at least a little bit of avenues to be able to try to comply with the law. But going into now that we're toward the end of tax year 2024, we are currently not anticipating the law changing for this tax year.
And not to cut you off, Sly, I think that's a positive thing, right? Because it's always been in limbo the last couple of years. And so I think for everybody out there, the positive side is we don't have to have this concern of like what's going to happen. It is what it is. 174 is in place. 2024 tax year, we're going to be doing it business as usual as we have in the past. And then obviously look for some sort of change in the 2024 year that will probably affect the 2025 in the 2025 year that will affect the 2025 tax year. So I think that's something that's on all of us, and including our clients. It's always been this. We just don't know what to do right now. I think we have clarification and knowing what we're going to do for the 2024 tax year. So I think that's going to take the burden off of waiting or not knowing when or how, right?
Yeah, to your point, Tim, a lot of the TCJA provisions sunset in 2025, meaning that there's probably going to be a tax package, particularly with the way that the election went. But most likely for the 2024 tax year, we're still going to have a year of 174 amortization. So that'll be the third year that this law is in effect.
Yeah, and something that we've been focusing on, and I know that we're going to have a lot of information coming out on this here soon, but something we've been focusing on is for people that have not been able to be compliant. There's an option for them to do that. Kind of removes a little bit of the kind of the lump sum burden that they would have received initially. Maybe you could kind of walk us through that a little bit and give an idea of what that looks like.
So 174, when it first came out, was considered a change of accounting method. So the taxpayers were able to file a simplified statement that acted as a 3115 change of accounting method statement on their very first tax year. Going forward, you have to file a normal 3115 and take into account the adjustments that would have taken place in 22 and 23 for the 24 tax year. But as you pointed out, this obviously comes with a very large 481A, positive 481A adjustment that on first glance can look pretty burdensome to taxpayers. However, with the 3115, the positive 41A adjustment, there is the option, or maybe not even necessarily the option, it does say that you take that positive 4A1A adjustment over 4 years, starting with the current year. So while it's still a lot of income that can possibly lead to a larger tax bill, that tax hit gets spread out over 4 years as opposed to taking it all in 1 year. So that certainly makes compliance and for those taxpayers that thought, well, 22, it's just going to be a temporary thing, I'm not going to worry about it. 2023, it's still just a temporary thing, I'm not going to worry about it. Gives them an option for the 24 year to make sure that they're compliant, because in the event of an exam situation, it's much better to argue the dollar amount and maybe what was claimed versus whether or not you're compliant with the law. So this, again, gives taxpayers a palpable option to be able to get in compliance with the law and still be able to make those estimated tax payments, or make those tax payments that they're able to be in compliance.
Let's just take some simple numbers to see what this looks like. Let's say we have $1 million, okay, of 174. Can you break that out for us of what that would look like with this adjustment? Is that possible for you to do that for us?
So the easiest thing to do would just be each year, essentially, instead of taking 100% of the deductions, you're only able to take 10% in the current year and then 20% in the following years. So in the very first year, say you had an increase of $900,000 of taxable income.
Yep.
Assuming a 21% tax rate, that's about $190,000 worth of additional tax in that first year. For the second year, you still get that 10% for the 23 year and 20% for the previous year. So 30% deduction. So it's still $700,000 of tax. It's probably about another 140 grand of tax. So as you can see, it starts going down. So rather than having to take that, what would that be, about $330,000 of additional tax all in 1 year in the 24 year, in addition to what the tax hit would be for the 24 year of amortizing that same $1 million consistently year over year, you can still spread out that additional tax for 22 and 23 over those 4 years. Again, making it a lot more palpable to be able to make those tax payments to be in compliance with the law.
Yeah, I think the biggest thing is you're able to get yourself compliant, right? The concern of the IRS coming around, we're seeing the IRS come around with some of these, and I know it's been some sticky situations for some people, which has created some major challenges, and we've had to come in kind of the back end. There's a major burden with that instead of kind of this adjustment that they can make to find themselves compliant. So I think this is great. I really do think it's going to help out of a lot of our clients, any future clients that have kind of been worried about this situation. But I personally believe that this is going to kind of take some burden off of some taxpayers for sure. So the good thing is, Sly, I know that you and TJ did a Let's Talk Tax podcast, correct? That I believe is going to be coming out this week. There's going to be a lot of information with this circled around this. So please make sure that you all kind of listen in. I think it's going to be a great episode and really insightful and give some good keynotes for you and your taxpayers to be able to kind of take advantage of this situation. So if there's any questions that come up or anything that you have or need, please reach out to your relationship manager here at McGuire Sponsor. And obviously, Sly and I are always available. But we appreciate it.